Our studio in New York City. I'm Julie. Afternoon. We're an hour away from the closing bell on Wall Street. Stocks little changed after the latest reading on inflation came in line with expectations. Mixed moves right now for the major indices, and tech stocks are outperforming. We're breaking down the market action and what it means for your portfolio.
And later this hour, be sure to tune in to a Yahoo Finance exclusive with Cleveland Federal Reserve President Loretta Mester. Our own Jennifer Schonberger sits down with her one-on-one and gets her take on today's PCE report and what it means for the Fed's path toward cutting rates.
Plus, mortgage rates hitting their highest level since mid-December, and with borrowing costs creeping higher, sales have been slowing down. We'll hear from one of the country's largest home builders on what it'll take for the frozen housing market to thaw. Let's get you up to speed on the market action here today. As we said, a mixed picture is what we're seeing for the major averages. The Dow, very little change, down just about 14 points right now. The S&P up about 1/3%. The Nasdaq up about 0.6%. Information technology is the best performer in the S&P 500 today. We've got financials and healthcare on the downside here. But a lot of it, Josh, does indeed have to do with that reading on inflation.
Yeah, the big economic data point of the day, Julie. Let's start there. PCE, the Fed's favorite inflation gauge, of course. We did have a couple inflation prints recently. You got CPI, PPI. They came in kind of higher than expected. So we were focused on PCE and specifically core PCE, which excludes those volatile food and energy components. That rose 0.4% in January. That's an acceleration over last month's increase, but it was still in line with consensus, with what economists had been forecasting. And core PCE rose 2.8% from a year ago, and that was slightly down from the annual gain we got in December. And the market seems to be saying, okay, PCE came in on target. It's not maybe where Jay Powell wants it just yet, but it is, on target and below 3%.
Right, and the fact that it wasn't worse than estimated really means that we didn't see that big reaction in the market. Looking at some of the economist commentary here, Chris Rupke, chief economist over at Forward Bonds, said the inflation scare in January seems unlikely to continue. That was echoed by Christian Guha over at Evercore ISI. He said basically that January will turn out to be more of a bump in the road than a new trend. So that seems to be consensus right now. All of that said, most of these economists are still thinking, May or June more likely. That seems to be where the consensus is coalescing, and that the data that we got today did not change that. Therefore, to bring it back to the equity market, that's why you're not really seeing a sort of decisive direction in stocks today.
Not enough here, really, you're saying, to kind of disrupt Jay Powell's story, the narrative of, we like where it's headed, we're not there yet, and we're going to stay patient.
Yes, but let's get somebody else's view on all of this. For more on the latest economic data and what it means for both the Fed and investors moving forward, let's welcome in Dan Skelly, Morgan Stanley Wealth Management Managing Director and Head of Market Research and Strategy Team. Thanks so much for being here. So, you heard what we were saying about PCE here, that the numbers today don't necessarily seem to disrupt the narrative on the part of the Fed, that we're looking at perhaps a May or June rate cut. Was that sort of your reading as well, or are you still concerned and you're going to be watching the February numbers very closely as well?
Sure, and thanks, Julie, for having me on. It's great to be with you. So, look, I think as mentioned, it was pretty much in line today, and that was a relief, as you're seeing in the market at the moment, after what had been hot CPI and PPI, throwing a little bit of cold water on this idea of disinflationary growth, which had been the trend for a while. But I think importantly, Morgan Stanley as a whole, and Ellen Bettner, in terms of our chief economist, has been expecting June for the first kickoff day in rate cuts for a while. We think the market was ahead of its skis. Back on Jan 1st, you were basically 100% priced for a March cut, and we thought that the first couple of months of this year would present a more lumpy set of inflation data, and that's just what we've gotten. So today is a bit of a relief to see that we're still probably on our way towards mid-year for cuts. By the way, that's where the market is really coalescing as well. And I would just lastly say, Julie, that the idea whether or not from here, if we have 3 or 4 or 3 or 2, is probably much less impactful. I think it's actually a very healthy sign that we went from pricing 6 to 7 to closer to 4, and that wasn't disruptive at all to the market.
And Dan, I'm interested in switching gears here. Also, so that's the Fed. Let's talk earnings as well, Dan, because we're obviously winding down the earnings season here. You got some prints after the close, Dell, HPE today. But Dan, I'm just interested to get your take on the earnings season. What did you learn, Dan? What were the big takeaways for you?
Yeah, excellent question, Josh. So a couple things. First, we saw in really the last week or so as big cap tech reported, the skew in terms of an overall positive, healthy earnings picture is actually improving. So you're going to look at maybe +5%, +6% overall earnings growth for 4Q23, which is, I think, helping support the idea that the earnings recession is over. We had 3 quarters in a row of earnings declines last year, as you know. And so I think we're finally starting to see, an overall pickup, of course, again, led by big tech. And frankly, a lot of the revisions that we're seeing are from some of the same revisions winners from last year. And so the big question, Josh, is when does the rest of the market, right, the S&P 493, start to see their earnings improve? And I think it's a function of 2 things. First, I think it's this idea whether or not the top line and the revenues can sustain, and that's going to be dependent on the economy. Overall, the economic reads have been positive, as we've talked about. But more importantly, I want to introduce the concept of not just Magnificent 7 or 493. I think it's all about what the Fortune 100 does with AI. And what we're hearing from a lot of companies, a lot of industries, is that the second half of this year is the window to start to more tangibly quantify how much AI projects may impact the revenues and the earnings power of other industries. And so that could be something to watch later this year.
Dan, it's really interesting that you bring that up because we're coming off a week in which, Google in particular was under scrutiny because, well, their AI was making some mistakes, right? And so it also raises some questions about the time frame that people are looking for this stuff to make a real tangible difference, as you say, a real tangible monetizable difference also, by the way, right? So I just wonder what you're looking for in terms of where we're going to see that really start to bear fruit.
Yeah, really interesting question. So a couple things. First, we do pretty broad-based survey work at Morgan Stanley Research, and a couple really notable things stood out in the most recent 4Q survey. So number one, the survey said that AI as a spending priority is number one for the first time in that survey's something like decade-long lifespan. Number two, the time frame, or again, the window for which many companies surveyed are saying that the AI projects or the AI initiatives are actually going to impact their productivity or revenues is actually in the second half of this year, early 25. And I guess the very last thing I would say now is just kind of unpacking AI and generative AI, which is truly the newest phenomenon as of the past year, versus other uses of industrial technology. And this is important because the other uses of industrial technology has to do with this concept of tech diffusion and big data and the data era leadership. These are themes Morgan Stanley has been writing on for literally 7 years. And so while AI and generative AI had its kind of big aha moment last year, some of these underlying themes are also starting to permeate the rest of these industries. And so I think that's important to watch too. It's not just going to be generative AI. It's going to be the idea that the intersection today between companies emerging from an earnings recession and having more capital on hand, the fiscal initiatives that are being led by the government that are very much infrastructure and tech and renewable related, intersecting with certain companies' revenue streams as well. It's really, again, the intersection of all these different trends coming together today where, we do think it will be impactful later this year.
Dan, I'll get you out of here on this. Major averages on track here, Dan, for their 4th straight month of gains here. I'm interested to get your take on valuation. And I asked Dan, because we had some strategists on this week on the show who said, to their eye, valuation is actually looking maybe a bit rich here. What do you think?
Valuation is certainly fair when you look at the S&P 500 level. You consider the fact that we're trading around 20 times forward earnings. We personally think that the market should trade at a higher multiple sustainably because the mix of the composition of the market has improved over time towards a higher growth, higher quality, less debt skewed type sector, again, with a lot of that emanating from tech. So we think it deserves to trade at a higher multiple. I think, again, the macro backdrop has implied that the lion's share of the rate move from 5 to 4 from last summer to now, particularly given Powell alluding to rate cuts in December and the market being more 100% priced for middle of this year rate cuts, I think the lion's share of the multiple expansion has happened from rates, giving you a tailwind. And so again, Josh, the question comes down to where does the multiple where does the multiple level out? And this is where the upside, again, could be based on a couple of things other than fundamentals. And I'll just quickly go through them. So there has been hand-wringing over the election. I think it sort of remains to be seen, obviously, how we get there and what happens. There's a lot of uncertainty. But notably, this is one of the only elections in history where both candidates have been in the White House prior. And in both instances, Biden and Trump, you saw pretty benign markets and economy. And so maybe the election just proves to be a nothing burger. You've seen, obviously, a ton of flows into money markets chasing yield. And again, if the Fed is cutting, I think those weaker hands may acquiesce to equities in the form of more aggressive flows later this year. So again, the question is, aside from rates and earnings and fundamentals, do you get a little bit more multiple expansion this year simply from hotter flows and from some of these other kind of intangibles fading away? It's certainly possible.
Dan, you gave us a lot to think about and chew over. Thanks so much for joining us and helping us kick off the show today.
Thank you very much.
Now let's check in on some of today's top trending tickers. AMD is going to kick off things here with another semiconductor stock. It's nearing all-time highs here. Shave AMD soaring today, and if it closes above $185.67 per share, the chip maker will end today with a market cap greater than $300 billion for the first time on record. The move coming on the heels of a note from Citi saying it is still wildly bullish on the semis. So AMD, by the way, Julie, hits a 52-week high in today's trade, on track to close, we said, market cap greater than $300 billion. That is a first for Lisa Su's company, a milestone. And what a run. I mean, look at this chart. It's up about 30% already this year. It's up about 140% over the past 12 months. And that run has not shaken analysts one bit. They are still confident as ever that you should buy this. Gross majority, 76% still rated to buy. So almost near NVIDIA like love on the street.
Yeah, and when you quoted from that Citi note, that is a direct quote.
Yeah.
We are, quote, still wildly bullish on semis. You don't see language like that from sell-side analysts very frequently.
Usually much more contained group.
Right, yeah. I mean, even though they like their puns,
they love the headline.
to be clear. They love the headline. Yeah. But still, it's interesting to see that. And by the way, the analysts there don't just like AMD, they do still like NVIDIA. And they like Broadcom as well and say the upcoming Broadcom earnings will be another positive catalyst. Those Broadcom earnings, by the way, are coming after the close on Thursday. So that's the next thing to watch here to see if it's another catalyst for the industry. And it's interesting that they're also looking at the so-called the DRAM market, which is one of the memory chip markets, that continues to improve with beat and raises by Samsung and Hynix. And they're looking ahead to Micron as another, again, positive event in that subset of semiconductors.
Wildly bullish. They like the demand trends they're seeing in these end markets, from PCs to servers to smartphones, and the AI market continues to grow. They told clients, all kinds of companies basically are saying, keep buying these AI chips.
It's pretty incredible. Let's talk about Snowflake as well. Those shares are falling today by 18% after it issued a downward revision to its fiscal year 2025 guidance and announced, importantly here, CEO Frank Slootman would be stepping down as CEO, retiring as CEO. He is 65. And Slootman had been very well regarded in the industry, right? He took Snowflake public in 2020, but before that, he had been at ServiceNow and took that company public. He was at a company called Data Domain back in 2007. All of those had been outperformers. And so his reputation was quite strong. So him stepping down, seeming to pave the way for a renewed focus here on AI from Snowflake, because the guy taking over from him was the one who was leading those efforts at the company.
Yeah, it would, I mean, you can see the reaction. This is a really tough 1-2 punch for Snowflake. One, as you know, Slootman is stepping down here, very well regarded, well known, also very known for his toughness, by the way. And you have that coupled with financial results, which were disappointing. So the sales forecast Product revenue, they were saying 745 to 750 million. That isn't good enough. The street wanted to see closer to 770. Now, whether those two things are sort of linked is an issue some analysts are raising. In other words, the new guy maybe is being extra conservative here and prudent. He obviously doesn't want to step in on the first day on the job over promise.
Right.
So maybe there's some link here between the two.
Yeah, I mean, it's interesting. Bank of America pointing out that new CEO, Sridhar Ramaswamy, will likely focus on accelerating the company's AI and machine learning offerings. And one other analyst, Frank Havemeyer over at Macquarie, said that this forecast cut may have been what he called a clearing of the decks for Ramaswamy, which is kind of interesting here, like giving him upside to perhaps beat that forecast, but we'll see what ends up happening.
All right, let's end here on another stock that is down big today for sure. Shares of Chemours company sinking after the company suspended 3 top executives, including the CEO, Mark Newman. Company put off reporting its fourth quarter results for the second time this month. So this stock is getting hammered today, and for good reason. So titanium dioxide maker, CEO, CFO placed on leave, Julie. Sounds like this is due to an accounting concerns per report. So now the company is saying, okay, we're going to delay reporting our Q4 results again, second time this month.
Yeah, and the first delay raised some eyebrows, but this now raising even more. The chief accounting officer, by the way, also one of those who is taking a leave of absence here. And not only does it seem to be a delay here and some questions about accounting, it also has to do with reports into the company's ethics hotline. And so that's also why you're seeing such a dramatic reaction in the shares, because investors are saying, well, what does that mean? It raises a lot of questions about what exactly is being examined here. So that's something that we're going to presumably continue to dig into and get information about. The audited results, by the way, not expected to come for 15 days, according to Chemours. So, I think watch this space. This is definitely a developing story.
And analysts, by the way, are pulling out their red pencils and making changes. BMO, for instance, double downgrades to underperform. That's not a move you often see too often. And with this move today, by the way, that stock is down about 40% already this year.
All right. Well, moving on, we are just getting started here on Yahoo Finance Live. Coming up, what's next for the Fed's battle against inflation? Cleveland Federal Reserve President Loretta Mester will join the show for an exclusive interview with our Jennifer Schomburger. That's at 3:30 p.m. Stay tuned for that.
Mortgage rates rising again this week, reaching a 2-month high and flirting with 7% yet again. And it comes as pending home sales fell nearly 5% in January. Let's welcome in Cheryl Palmer, Taylor Morrison CEO. Cheryl, it's good to see you.
Well, good to see you.
I want to start with the 30-year fixed, Cheryl. Let's take a look at that. So we're not at 8% like we were in October, so that's nice. But according to Mortgage News Daily, we are at 7.1%. What does that mean, Cheryl, just for the housing market and home builders?
Yeah, it's been volatile for a while now, right? Like you said, we were at 8% in the fall, then we were at 6.5%, now we're at 7%, just over 7%, I think, at par. I think the consumer's getting a little bit more, I think, recognizing that we're seeing this kind of volatility. What does it mean? The consumers have come a long way in the last year, 18 months, when rates were flirting at that 7%. But the difference from where we are today to where we were then is back then they were still hoping rates were going to go back to 4%. And I think the consumer has met us kind of in the middle, recognizing that rates in the 5s or 6s is actually, from any kind of long-term historic perspective, a really good rate. So, what we are able to do in the new home market is really help our customers understand the different programs that are available to them. So we're able to go into the market, buy what we would call a forward commitment, have that available. So a customer walks in, and even though they could go to the bank and get a 7.25 rate, we can offer them like a 5.49. Maybe FHA, it's 4.99. The reality is every buyer needs something a little bit different. Some need help with cash to close. Some want the confidence of a 30-year fix. Some need, maybe the next couple of years they want a lower rate, so it's a temporary buy down. So really the ability to personalize it today, I think, is most important. But I think it's created a real advantage for the new home market versus that opportunity doesn't really exist in the existing market.
Well, and all of that by another name would be incentives, right? You're offering incentives to these home builders. Right. But I am curious, as rates hopefully at some point start to move down, do you all get to pull back? When do you get to pull back on those incentives, which presumably would be better for your bottom line?
For sure. I think, honestly, we already have, because if you go back to that point in time when, let's say, rates were 7 a year ago and the consumer wanted something around 4 and we were offering like 4.49, that seemed to be the magic number. The cost of doing that was more expensive than when they're in 7s trying to get to a mid-5. The average rate that we're closing consumers with in the fourth quarter was actually 6.7. So the consumer, when I said they've met us halfway, they've met us more than halfway. If I went back to third quarter, I think that was 6.5. Now that's the final takeout coupon rate. So maybe they've got a rate, and that's our average across everything we closed. So maybe they have a rate that is, 4.7, 5.7, and then their final rate is 6.7. But those are different ways we can, utilize to bring the cost down. And once again, I think the customer recognizes rates in the 5s and 6s is really good.
Yeah. Sure. I'm curious, what your kind of inventory looks like right now, just across the production cycle. A new home,
it's pretty low.
Finished.
Yeah, and it's a really important point because we've actually seen a slight rise in total inventory in the new home market. I think we're almost at about 8 months of inventory. The real key statistic is we only have 1.4 months of finished inventory. So you need some finished inventory. Some people, are moving, they come into a new market, they need a house. Some are coming out of an apartment. So actually by all standards, it's almost a little too low. So inventory's good. I always say to our team, inventory's good. You just want to sell it while it's in progress and not have a lot of finished inventory. And that's kind of where we are. So if you look at the new home inventory at about 1.4 months of finished, and you look at the resale market at around 3 months, just moved up to about 3 months, that's still really low. So in total, we're really undersupplied.
Yeah, I mean, that's how it feels. Certainly that's how it feels on the existing homes market side as well. Just real quickly here, where's the tipping point in this housing market in terms of where we are going to start to see more of a dramatic reacceleration in sales? Is there a magic number for mortgage rates, for example, for the 30-year fixed?
Yeah, it's a really good question. I don't know if it's as much about the rate, one person's opinion, as just the signaling that this volatility is behind us. Because I think two things can happen here. One, when you think about rates, we're in the sixes kind of at the end of the year, we did see an acceleration. We actually, since rates have moved to 7, because of all those tools, we actually haven't, as I said on our earnings call, we came into the first of the year with a pretty strong January and early February. So the spread today between the 10 and the 30 is equally as difficult, or I think sticky for us, as it is whatever the Fed does. Because I think when the Fed kind of signals we're ready, I mean, he's kind of done it, right? But not fully. There's a little bit of mixed messaging still there. Then I think you start to see a reduction in that spread. Then, you know, if it's summer, if it's fall, everyone has a different view on when that happens. I think that means we know we're not going to have this volatility. There's great demand out there. So I think people pull off the sidelines. Nobody wants to have the highest rate.
Yeah, I know a few people who are in the market. Cheryl, thank you so much. Appreciate you being here.
Thank you, Cheryl.
Good to
Thanks
see
a
you.
lot. Well, markets today, stocks, that is little change, but it turns out Thursday is the best day for stocks. Jared Blickery, I didn't know that, is here with the details.
That's right. Guess what? It's Thursday. Guess what happened last Thursday? That was the day after NVIDIA announcements when they tacked on, I don't remember how many trillions to their market cap. It was about 277 billion if my memory serves me. But overall, I'm tracking the days in the market Monday through Friday. And since those October lows, that pink line up top, this is Thursday, and right around there, you're going to see a purple line. That is the S&P 500. That's scaled on the left. But the next best day is Friday, and that's green. That's a little farther down, and you can see that's really flatlined during the month of February. And then also, I would add that Monday is still positive here, but Tuesday and Wednesday are negative since the beginning of the year. So there have definitely been some better days to be in the market than not. I've also been parsing the market by time of day. And as it turns out, the gap, the overnight gap, if you were to buy on the close and then close on the open, in other words, you were long the stock overnight, long the index overnight, that's actually the best place to be. And it's not surprising because the market is actually closed 17 and a half hours per day. It's only open 6.5 hours per day. But so one of the characteristics of a bull market is you want to have the gap leading, and that's been the case since those October lows. Wasn't necessarily the case going back before those October lows last year. So just improving characteristics of the bull market. Now, since we got just a little bit of time left, wanted to show you what's been happening this month in terms of sector action. Going to do a deeper dive right after the close, but here's the large caps sectors for the month of February. Consumer discretionary, that is by far and away the best performing sector, but then industrials and materials, been talking about the broadening rally. Tech is number 4.
Jared Blickery, thank you, appreciate it. On the other side of the break, we got an exclusive interview with Cleveland Federal Reserve President Loretta Mester coming up.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. Well, the Federal Reserve's preferred inflation gauge showed prices heated up in January. This on the back of a hotter CPI and PPI, raising the question of whether inflation is stickier than thought. So how does the Federal Reserve view this, and what does this mean for the path this year for cutting interest rates? Joining me now in an exclusive interview is the president of the Cleveland Federal Reserve, Loretta Mester. Loretta, thank you so much for joining me. It's great to see you.
Thanks for having me. Appreciate it.
So, your reaction to this morning's PCE data?
Yeah, it came in about the way I expected it to. I mean, we'd already gotten as you mentioned, the CPI report, so it wasn't too surprising that came in a bit higher than we've seen in the December readings. It doesn't really change my view that inflation is going to be downward. Going down, down to our 2% goal over time. But it does show you that, there's a little more work for the Fed to do here in terms of making sure that we can get all the way back to that 2% goal.
So then how are you viewing this number in the context of, you mentioned CPI and PPI, which were hotter, and we're seeing a divergence, right, between CPI and PCE in terms of the holistic inflation picture? Are you putting more emphasis on PCE?
Well, of course, our goal is phrased in terms of PCE inflation, but we do look and monitor a whole panoply of inflation numbers. I think the bigger picture is we've definitely seen inflation move down from its highs. And really what this is all about now is risk management until we get back, right? And doing that until we get back to our 2% goal is going to be important. So right now, my feeling is that my baseline forecast is that we'll see some moderation in demand because we do have restrictive monetary policy, and that's affecting the economy. We haven't seen that much on the consumer side yet, but we have seen some signs that consumers are being more careful with their spending, right? We have seen it on business investment. That's come down. And we're seeing it in manufacturing. When you go out and talk to manufacturers, they're being more cautious. And so that's going to help, bring supply and demand into better balance, and then that'll help get the inflation back down. That's up till now, a lot of the movement has been on the supply side, right? So global supply chains have been normalizing. They were very restrictive before. Those kind of disruptions have been easing. And on the labor market, we've had people come back into the labor force, and the labor force participation rates have gone up. So I think that's going to basically mean we can't rely on the pace of deceleration in inflation that we saw last year continuing, and it's just going to be continuing to make sure that we get inflation all the way back to our 2% goal.
So when you look at this morning's number, how does this change the calculus, if at all, for you for the policy path?
So it really doesn't change my calculus because what I need to see is, better balance between demand and supply continuing. As I said, we have seen that come into better balance, but there's more work to do there. When we do that, what we'll probably see is wages continue to disinflate a little bit more than we have already. I mean, when we talk to our business contacts in the 4th Federal Reserve District, what they've told us is that their expectation is that wage increases and nominal wage increases this year will be 4%. A year ago when we asked them, it was 5%. So you have seen some wage, come down, and that's also very helpful in terms of getting inflation back down to 2%. I do think demand will begin to moderate further, and that growth this year will not be as strong as the growth we saw last year. And that normalization, coming back to better balance, is going to be what gets inflation back all the way back down to our 2% goal over time.
Do you think there's enough time between now and the June policy meeting to get enough confidence in the downward trend for inflation? Bumpy has sort of been the term that a lot of your colleagues have used, but do you think there is enough time between now and June to start to get that confidence to begin cutting?
So I think I would like to phrase it not in terms of time, right? This is really about how is the economy evolving? Is it evolving according to what we expect, right? And that, for me, it's, growth slowing a bit, moderating a bit, inflation continuing to move down, right? And I do expect that there's going to be some slowdown in employment growth, right? Not a bad, employment picture by any means, but I do think we'll see some moderation on the employment side. And those are the conditions that we need to see to be able to assess, okay, the economy is evolving the way we want. If inflation expectations, a year ahead, inflation expectations continue to move down, right, then I think we're in a good spot where we could consider, right, an easing of the restrictive level that we're in. But we have to sort of allow the economy to be able to do that. And you're right to point out that one of the things is we need to be more confident that inflation is on that sustainable downward path back to 2%.
To your point on the employment picture, Fed Chair Powell said that back in the January press conference that if there were weakening in the job market, that would point to cutting rates sooner. So if we were to see a couple of cooler employment reports, an increase in the unemployment rate, would that be a trigger to cut rates?
I don't think of it as a trigger. What I do think it's going to be characteristic of policy this year is really risk management, right? Up till now, really, when inflation started moving up, higher than anyone wanted or liked and well above our goal, right? And employment was actually pretty healthy. Our sole focus was on our price stability part of the mandate. Right now, as inflation has started to move back down, which we're very happy about, right? We need to start now managing the risks around both parts of our mandate. And I think that's what is characterizing policy this year. Now, we have the luxury of being in an economy where growth is still very good, very solid, and labor markets are still quite strong. And so that gives us the opportunity, right, to collect more data, assess conditions, assess those risks, and see that the economy is moving in the right direction so that inflation gets down to 2%. I do expect, my baseline forecast is that we'll see some moderation in the labor market, but that it'll stay healthy. And that's what I'm looking for. That'll give me more confidence, right? That along with the fact that inflation continues to move down, that we'll want to start thinking about the next phase of policy. If things evolve differently than what we expect, right, either on the inflation side or, as you pointed out, on the labor market side, then we'll have to reassess, right, the policy stance.
If we get to June, middle of the year, and the inflation picture, the economic picture looks similar to what we have right now, would that be an argument to push back the timing of rate cuts or to cut back on the number of rate cuts?
Well, it depends on what you mean by looks like what we have now, right? We need to see continued disinflation. We need to see inflation moving sustainably back to 2%. And you're right, any one data report, right? We don't want to move on one data report. We want to sort of see that the trend is continuing down. And so I think we just need to sort of look at that, right, evolution of the economy to be able to assess, right, the balance of risk, right?
And you're still viewing 3 rate cuts this year as your baseline?
Yeah, that was what I had submitted in the last round of SEPs. We'll get another round, of course, and I'll do a total look at it. But right now, that feels about right to me if the economy evolves as I anticipate it will. But again, if the economy moves in some unexpected way, we'd want to take that into account when we're thinking about policy.
And you've also mentioned, and I know you don't want to put a time frame on when you're going to cut, but you have used the phrase later this year. That is still your thinking at this juncture, given this morning's data?
Yeah, I mean, given what we're seeing and the fact that we are in an environment where growth is solid and labor markets are very healthy, I think we have the opportunity here to be sure, to see that things are evolving, right? It would be a different picture if things weren't evolving according to our, expectation. But right now, we're in a really good spot. I think both the economy's in a good spot and monetary policy's in a good spot. And that gives us this opportunity really to look at, the balance of risk between our dual mandate goals, making sure that we're on that sustainable downward path to 2% inflation.
Loretta, thank you so much for your insight. As always, it's great to see you.
Thank you very much.
That's Loretta Mester, president of the Cleveland Federal Reserve. We'll be right back after this.
Welcome back. Markets are now higher across the board. Cleveland Federal Reserve President Loretta Mester just telling our own Jennifer Schonberger that she still sees 3 rate cuts this year. Joining us now is Chip Huey, Truist Fixed Income Managing Director. Hey, Chip, good to see you. So very interesting to hear those comments from Mester. And sort of echoing the sentiment that we've heard that the Fed still feels like it needs to see more evidence. And I guess the PCE report today also sort of brought that home. What do you think the Fed needs to see, and what do you want to see that lets you know that they can do it?
I think they clearly just want to see more evidence that what they have seen so far is not sufficient enough. I think today's PCE data really confirmed that it is going to be that bumpy path down to the 2% target. And so they just need more time and more data to come in and confirm that inflation is cooperating. So I think they're taking a very data-dependent and pragmatic approach. I really enjoyed her comments a lot. And we think that by the middle of this year, around the summertime, that evidence will have built sufficiently that the Fed can move forward with that initial rate cut and ultimately lower by 25 basis point increments roughly 3 or 4 times before year end.
It's interesting, Chip, because Larry Summers, our former Treasury Secretary, he recently made some headlines, Chip, and obviously when he speaks, people listen. And he thought there was actually a meaningful risk, his words, that the next move in rates was actually upwards, not downwards. But it doesn't sound like you agree with Dr. Summers.
Yeah, I think that where the policy rate currently is set is at a very restrictive level. And it's growing more restrictive as inflation continues on this bumpy but still downward trend. So I think that the current setting now is sufficient to have the effect that the Fed wants, right? To cool demand, to get inflation to fall. I don't think the Fed is going to need to continue to raise rates, but that was what we've really been saying since late last year, that it was going to take time for the Fed to actually entertain rate cuts. They had the experience with inflation over the course of the past couple of years that is making this process a very cautious and slow one. But I don't think they'll have to add to the tightness to continue to see the progress that they've put together over the course of the past 6 to 12 months.
And do you think that this sort of financial condition tightness will continue even if the Fed starts to cut? In other words, will rates really come down meaningfully even when the Fed does finally begin?
Yeah, I think that any kind of cuts would be completely predicated on inflation cooperating and coming down. So if the Fed funds rate is coming down sort of in lockstep with inflation and maintaining that sort of real yield differential, I think that is consistent with a kind of downward pressure in yields. I think that they would follow certainly in the front end of the curve where you're more policy sensitive, but out in the intermediate long end as well.
So Chip, if I'm looking at the yield on the 10-year right now at 4.25, near to intermediate term, you think we're sort of range bound here?
I do think we're somewhat range bound. We have seen some upward pressure kind of return when you get concerns around budget deficits and all of the strong Treasury issuance that will need to continue to sort of backfill those deficits. So we do expect some periodic upward moves in response to that. But ultimately, we do think that the broader trend as we progress through the year is to lower yields. Now, inflation is still somewhat elevated relative to what we've seen over the past decade or so. So that probably raises that floor a little bit. But from where we are now, we view the 10-year in that 4.25 range as fairly valued. And if we saw those upward moves based on concerns around maybe Treasury supply or deficits, that likely would create more of a buying opportunity in our minds ahead of what we expect to be a bumpy but still downtrend in yields.
And I was going to ask you to dig into that a little bit strategy-wise, kind of where you're looking on the curve right now. And also if you're talking to a retail investing audience, right, and maybe they're looking at it through bond ETFs, for example, are there sort of areas, subsectors that you think are most interesting?
Yeah, I think for those that are seeking really high quality passive income, that the front end of the yield curve, say T-bills, for instance, is really compelling because we do think the Fed is going to be able to ease policy as we move through the year. And therefore, that should put downward pressure on the front end of the curve. So for those that are kind of saying, when is the right time to get that money to work? Our message is, probably a little bit of urgency at this point, right? Go ahead and get that money to work. We do think that those yields are going to fall. I think I would use any upward pressure from here in this fair value range. There's a big technical support in the 10-year at about 435. If we were to break through that, I think that we would kind of view duration instead of more neutrally or fair valued as more attractive. And so I would be looking for that kind of opportunity for extending duration. Right now, I would be a little bit more patient on the duration front.
And then I'm curious on the corporate side too, what you think, because there's just been enormous issuance, right? There was a record, I think, in January and February for the amount of corporate debt coming to market. Does that also represent a really good opportunity?
Yeah, I mean, you would expect with that, you're exactly right. Record-setting issuance in January and February in investment grade, and you would expect that kind of supply to put upward pressure on spreads, right? To make their relative valuations a bit more attractive, to entice investors to get into the market and purchase that. We did not see that at all. In fact, we saw spreads continue to tighten. So on a relative basis, credit still looks, whether it's investment grade or high yield, looks pretty expensive on a relative basis. Now, absolute yields remain attractive, but for those sort of looking for a timing on a relative basis, for a more attractive entry point on a relative basis, we would be a bit more patient and let those spreads start to reflect, the sort of downstep in growth that we expect going forward. And so right now, those spreads are well below average, in fact. So even getting back up to more average levels would be more aligned with our sort of economic outlook. Right now, we don't think that compensation is really sufficient at this point.
Chip, thanks so much for joining us today. Appreciate it.
Thanks, Josh. Appreciate it.
Lululemon shares, they're hitting an all-time high. And according to our next guest, the fitness brand has a lot more room to run. He's raising his price target to $553. That's well above consensus, saying the brand has lots of potential overseas. John Kernan is from TD Cowen and joins us now. John, it is good to see you. So you keep your outperform rating here, John. You're a believer. You raise your price target to $553. That's up from $549. How come, John? Walk us through the reasons for that.
Yeah, it was just us going through our model and looking at where we think earnings estimates can be for 2024 and 25. And the valuation, I think, is cheap here relative to the company's long-term growth profile. And we think consensus estimates are pretty conservative for both top line and margins as we look into next year.
Well, let's address why they're conservative, John. Hey, it's Julie here. Just that there's been some concern about deceleration in sales domestically. And the company has come out with some new stuff, right? They've come out with men's footwear, for example. Do you think that the market's getting it wrong in terms of that deceleration, that maybe some of these measures are going to help juice the sales a bit?
Absolutely. I do think people are concerned to an extent. I mean, the stock is down about 10% from its all-time highs it set back in January when they raised guidance. I think that's on the concerns of the domestic business is probably growing very low double digits. We model it at 10%, domestic being North America and Canada. International is growing in excess of 40%. So international has become a much bigger portion of the overall growth profile, and I think it will continue to carry the growth profile as we go into next year. Domestic had very difficult comparisons. Lululemon had a monster holiday 2022 when sales in North America were up over 30%. So it's a bit of just tough comparisons, but investors are focused on some of the competitive headwinds that have emerged, as well as just the natural slowdown in sales off of tough comparison.
And John, just digging into China specifically, how do you see their business in China kind of evolving from here, John? And any concerns about maybe, homegrown competition over there?
China has been tremendous growth vehicle for the Lululemon brand. China revenue is going to grow over 50% in fiscal 23. We model it up another 35% in fiscal 24 to $1.5 billion. We think there's a lot of white space. The same-store sales results in China, which they don't report, but we can back into, we think are growing in excess of 30%. So clearly they are scaling at a very rapid rate. We don't think the local competition operates in the same price points and level of innovation that Lululemon does. So we think they're the leader right now in high-end premium athleisure in China.
John, the company reports about a month from now. What is going to be the most important number or most important comment that you're going to be zeroing in on to hopefully for you sort of confirm the view that you have on the stock?
Absolutely. They've already raised guidance for Q4. So Q4 is pretty much in the books. There was a little bit of concern whether January finished a little slower versus where they were running in December. But they already raised their guidance for Q4. It's really going to focus on the top line and EPS outlook for 2024, which we think is going to come right in line with consensus. And we think as the year goes on, we think there's going to be a lot of upside to consensus, particularly on the EPS line. So people will be focused on comps. Lululemon doesn't report comps by region, but they do report growth by region. So international, domestic will be dissected pretty closely. People want to hear what they have to say on some of the newer categories like you mentioned, and some of the materials innovation that they've announced recently.
Should be interesting. Thanks for that roadmap, John. Appreciate it. Take care.
Thank you.
We're just moments away from the closing bell on Wall Street, and guess what? It could be a record close on Wall Street. The S&P 500 on track for a record close. And guess what? The Nasdaq is on track to close at a record. The other major averages have been getting there, but the Nasdaq Composite has not since November 19th, 2021. So it has been the one left behind. The Nasdaq 100 has been making those records. The S&P 500 has been making them. The Dow's been making them, although it's not on track to close at a record today. So this will be a big milestone for the Nasdaq Composite.
Yeah, it's remarkable. I mean, listen, in part, we were talking about the big data point today, PCE. Kind of, listen, it's not, as we said, it's not where the Fed wants it to be, but it's below 3%. So maybe that gave markets a sense of relief here. It didn't shake up the narrative. At least the story that we think the Fed's telling themselves.
Yes, it feels that way. All right, we got to leave it there. We'll be right back with the closing bell and those records. There's the closing bell on Wall Street. Let's do a quick check of the markets here. As we told you, we are looking at some potential records for the major averages, and it looks like we have gotten there rather comfortably, depending on the index that we're looking at. The Dow not closing at a record again today, I don't believe here, because 39,131 was the closing high for that index, still up about 0.1% on the day. The S&P 500 closing higher by 0.5% here, and it looks like that is closing at a record. And the Nasdaq Composite as well for the first time since November 2021. But I know Jared Blickery is going to confirm all those numbers for us. He has been watching them very closely.
That's right. A late day rally powering the Nasdaq to a record high. Jared Blickery is here with the very latest. Jared.
Thank you, guys. Just checking in on some of the indices around the world, not just in the U.S. Have we seen some outsized gains? The winner overall is over in Tokyo. We had an 8% gain in the Nikkei 225, also famously rose to the first record high in that market since 1989. But we want to check out the benchmark in the U.S. S&P 500 up 5%, and you are correct, Julie. The Nasdaq Composite notching its first record high close since November of 2021. So that market up about 6% this year, and some other milestones really interesting. NVIDIA, we got some interesting stats on NVIDIA as well, and you can take a look at the month-to-day totals right behind me on the Wi-Fi Interactive. But NVIDIA having the best month since May of 2023. It has been up for 4 straight months. Meta, best month since November 2022. It is up for 6 straight months. And guess what? Meta has been up 15 of the last 16 months. And if I just show you a chart here real quick, you can see the length of this run. Here's the 3-year chart, and there is that run that we're talking about, 15 out of 16 months. Apple did not have the best month. That's closing at the bottom end of its range. That's down 2% for the month of February. Alphabet also down 1.2%. So there's been talk that the Magnificent Seven maybe should boot a couple members. Even Microsoft lagging a bit, only up 4%, but NVIDIA up almost 30, Meta 25, Amazon up 14%. And let's just check in on the sector action. See who the big winner is. Consumer discretionary. I was just talking Amazon. Amazon is the biggest component there, but also Tesla. Tesla, a big one in there. And then you have industrials and materials. So I've kind of been harping and writing about the broadening of this rally, and the month-to-date totals really tell that story there. We don't get to tech, and it's not even outperforming until you get to the number 4 spot here. And also I'd add that utilities, staple, and real estate, those defensive sectors, those pull up the rear there. So overall, a hugely bullish month. And if I check in on some of our leaders here, not surprisingly, Bitcoin takes the cake, up about 45%, depending on your proxy there. What did not work during the month, cannabis. It looks like regional banks and also some corporate bonds, whether high grade or low grade, high yield, those did not work out. But just about everything, and even the fringier parts of the market, as we've been talking about, Julie and Josh, IPOs up 15%, disruption, that's ARK up 12%, and chip stocks, the stalwart of AI, up 11% for the month.
Yeah, interesting stuff. I even see retail up there, up 11% as well, the XRT. Interesting stuff there, Jared. Thanks so much for running us through all of it. And joining us now is Mark Lucchini, Janney Montgomery Scott, Chief Investment Strategist. Great to see you. All these records, Mark. What do you make of it? And can we build from here? Or do you think after you see records like this that stocks maybe are due for a pullback?
Well, Julia, I mean, I think longer term, we can certainly build on these gains, but we're ripe for a pullback. I mean, we've had an advance that's quite extended at this juncture. I mean, really looking back all the way from the lows of October of last year, where we've had very little corrections along the way of any depth or order of duration. And so as a consequence, we're ripe for something to come along. What might catalyze it? Who knows necessarily, other than the fact that valuations are certainly not cheap. And as a consequence, it gets to the point where stocks are priced for only good outcomes or expectations being met. Of course, that was the case today with regard to the inflation reading, with that, while at generally face value, it came in a little hot, kind of confirming what we saw earlier from the CPI reading. Nonetheless, it wasn't in excess of expectations. And that seemed to be enough for market participants to stay with the trade that's been working so far this year, which is long stocks, particularly led by some of those tech-related companies.
Any concerns, Mark, about the narrowness of the market's move here, and do you expect that to broaden?
Well, I would think if we continue to see the evolution of the economy work in the way it's been working, certainly over the last 12 months, and at least even so far here this year. Right now, the Atlanta Federal Reserve's GDP Now tracker just came out with a print this morning that showed this deep into the first quarter of 2024, 3% annualized growth. Once again, indicative of the kind of momentum that suggests the aversion of a recession is increasingly possible. I think in that environment, which inflation at the same time continues to grind down and toward the Federal Reserve's target, should allow for a broadening of the economy. In other words, seeing the sectors that were mentioned by the previous reporter, like industrials and financials particularly, beginning to take on a leadership kind of role, if only to match that of technology, if not to exceed it. In the meantime, where we did not see that, and right now the evidence is still a little bit out as to whether we're going to see that evolution, what we're seeing is, again, the kind of narrowness of the market that last year was renowned for. And it is a little bit troublesome not to see that participation, not just by sectors, but also the number of stocks, even within the S&P 500, going on to achieve new highs, or seeing the participation being matched from that of higher beta sectors, like, for instance, the Russell 2000. So we're watching for that to evolve, but in the meantime, staying long in this market, even with the narrowness as it has clearly been rewarding, and we think it's likely to continue to, because we don't see any imminent kind of economic related activity other than that which we all know about, being a known unknown, geopolitical concerns that can necessarily take the legs out from underneath this market for any, again, order of magnitude or sustained basis.
So, Mark, where do you stay long then? Do you stay long within those tech leaders that have been doing so well? Do you also stay diversified, and where are you looking right now?
Julie, it's hard to argue against that kind of leadership. I mean, if you look at the trends that are in place in comm services, obviously led by names like, Facebook, Meta, and Google, Alphabet, certainly Amazon, and even with the resumption in some advance in Tesla, helping to lead the consumer discretionary sector, at least on a capitalization weighted basis, and tech in general continues to be, again, rewarded for being high growth areas, high quality names, iconic names, in fact, with fortress balance sheets that are being rewarded in this environment more so than their more cyclical brethren or lower quality brethren. So yes, definitely, but we would also accompany that by two of the sectors that were mentioned earlier, both in my comments and by the reporter, and that is, of course, financials and industrials that also show similar signs of life with regard to current trends that are seemingly well supported at this juncture. Other cyclical sectors, basic materials, are showing some development. Energy looks like it's resuming some kind of advance, but they're still somewhat embryonic in nature, and we wouldn't chase them yet at this juncture. And as for the defensive names that were mentioned, the REITs, the consumer staples, and utilities, the good news there from a bull is their lack of working in this environment is indicative of more of a risk-on modality than risk-off. Otherwise, they would be usurping some of those aforementioned sectors in leadership, which they clearly are not at this juncture.
Mark, I also want to get your take on an interesting kind of debate I've heard around sentiment and just how you think about that. I have seen some strategists, Mark, they're looking at these sentiment readings and they feel like they're coming in hot and they believe they're kind of flashing a warning sign. I've seen other strategists kind of downplay that. How are you looking at it?
Well, it's a variable, Josh. I mean, like any other. I mean, I wouldn't necessarily bake a trade predicated upon sentiment. We know things can stay overvalued for quite a while, even when measures of sentiment, which is a softer gauge, or looking at some of the technical readings on relative strength, might show signs of overbought conditions. That doesn't mean they can't remain overbought for some period of time, or correct in time, meaning we move more sideways in a trading range rather than correct in price and have to see a deep pullback to restore some value and cool some of those more euphoric sentiment readings. Yes, anytime you see extremes in sentiment, whether it's ebullience or despair, those tend to be good times to be either trimming longs in ebullience or staging into longs in periods of despair. We're probably more on the side of improved sentiment that is tipping into areas of which we would encourage taking some profits and and particularly looking to rebalance in something that, believe it or not, is outside the equity space, which is in fixed income. As yields have backed up here closer to 435 on the 10-year, we think it's an appetizing rate that on a go-forward basis should prove rewarding for investors in balanced accounts that are looking to augment equities with something that can offer a fairly appealing coupon at this point.
Yeah, most definitely. Mark, it's great to catch up with you. Good to see you. Thanks for joining us.
Thank you, Julie.
Let's get to some breaking earnings news right now. We start with Dell. The stock is higher by almost 19% after numbers beating on the top and bottom line. Let's run through them quickly, shall we? Adjusted earnings per share coming in at $2.20. That's above estimates. Revenue did fall year over year by 11% as the company has seen slowing growth, but it's still better than estimated. $22.3 billion. Analysts had been looking for $22.1 billion. And both of the company's main business lines saw decreases: infrastructure solutions as well as client solutions. The infrastructure group beat estimates. The client solutions group missed estimates, Josh.
Yeah, so what's impressive about this, Julie, is this stock had roared into this print. I mean, it was already up about 20% this year. It was up about 130% over the past 12 months. And now you can see what we're doing here, at least initially in the after hours. Some key themes I'm really interested to hear about from the company is, one, as you mentioned, their kind of color on the PC market now and looking ahead. Kind of what are they seeing for consumer sales, for corporate sales? As you noted, that falls into the company's so-called client solutions group. You know, it's interesting, we heard from HP too this week, which reported weaker than expected sales. So it's just kind of interesting that puts and takes as we some are banking on this PC recovery. Also, this is an AI story too, the company's AI servers. That helps explain the move we have seen in this stock over the past 12 months. And analysts, I think, want to know, okay, what is the kind of AI order trajectory look like from here?
Right, and it seems like they're well poised to and well prepared to talk about that on the call, saying in the statement, we've just started to touch the AI opportunities ahead of us. So we will definitely hear more about that. One more important thing to mention when it comes to Dell, the company is raising its annual dividend by 20%
so
to $1.78 a share. So that also is helping matters when you look at how those shares are reacting.
Yeah, most of the street are bullish on this name, and some will say, it's interesting, Julie, they think Dell is sort of increasingly seen as this sort of alternative to Cisco, as sort of the kind of the one-stop shop now for enterprise IT infrastructure and services, which have been healthy. So, and you can see it being rewarded here in the after hours for sure. Coming up, HPE shares, they are sinking after reporting earnings. We're going to break down those numbers. It's coming up next.
Shares of Hewlett-Packard Enterprise falling by about 5.5% after the company reported earnings for its first fiscal quarter and also cut its forecast for the full year, notably. So it looks like that is really one of the big things that is pressuring the shares here, I should say. For the full year, HPE now says adjusted earnings per share will be $1.82 to $1.92. The upper end of that forecast had been $2.02. So bringing down the upper end of the full year forecast here. The company's fiscal second quarter forecast is also below what analysts had been anticipating for both earnings per share and for revenue here, Josh. So all of that weighing on the shares right now.
Yeah, and importantly, this stock had not done a whole lot heading into this print. I mean, year to date it was down. Over the past 12 months, it was down. I think it's going to be really interesting. Let's hear what CEO Antonio Neri has to say about the general, just kind of IT spending environment, the puts and takes. Interested to get color on his compute unit. That's hardware like servers, his storage unit. Also, what does he have to say? There are those faster growing divisions of the company, Julie, like Intelligent Edge. And of course, you're looking for any updates on that company's big acquisition, kind of the roadmap to that integration of Juniper as a $14 billion deal.
Yeah, let me just quickly run through those particular units that you just mentioned here for the first quarter. Server revenue fell 23% year over year. And Intelligent Edge, which you mentioned is one of the growth areas, did rise 3%. Revenue there up 3% to $1.2 billion. Hybrid cloud revenue also $1.2 billion, but it fell by 10%. And then finally, financial services revenue flat year over year. Antonio Neri, the CEO, does sound cautious in this statement here, sort of acknowledging the challenges that the company is facing. He does say the company exceeded profitability expectations last quarter, but he said it was a mixed quarter. But he says, despite that, I remain very confident that our focus on customer-centric innovation, our track record, our operational discipline will allow us to capitalize on the significant market opportunities in AI, as well as in edge and hybrid, those growth areas here. So, we'll see what that looks like, how that translates, because right now it's translating into the stock being down.
All right, well, we have some insight coming on those very issues because Yahoo Finance Executive Editor Brian Sozzi, he is going to be speaking with HPE CEO Antonio Neri. That's tomorrow morning in the 10 a.m. hour. We move on. Marqeta reporting fourth quarter earnings that were in line with estimates and beating, though, on revenue. The stock is down in today's trade, though. That's after a strong recent one. To talk more about the earnings report and what's next for the payments platform, we're joined now by Marqeta CEO Simon Khalaf. Simon, thank you so much for joining us today. I want to get front and center, Simon, right away to an issue I know investors are thinking about, which is how quickly, Simon, are you going to be able to show GAAP profitability? What's kind of the pace there, Simon? Especially as they'll note, your volumes continue to grow here at a healthy rate.
Absolutely. Thanks for having me. It's so good to be on Yahoo Finance. I was part of your team about 5 years ago. Yes, I mean, GAAP profitability, as we have spoken to investors on Investor Day, we're aiming for 2026. But we did achieve the EBITDA positive milestone that we put in front of our shareholders. So we're still on track, and we're very excited about the opportunity.
Something that I'm trying to understand, full disclosure here, Simon, is kind of where you guys sit, right? And the companies that are your clients, the likes of Square, AKA Block, et cetera, what they're outsourcing to you versus what they're doing in-house. If you can sort of walk our viewers through that.
Sure, absolutely. So we have a lot of customers that use us for many things. And at the core of the Marqeta offering is issuing and processing. So if you want to issue a payment card, Marqeta is the issuer and the entity that processes that transaction. So whenever a consumer goes out and it taps their card, we see the transaction and we authorize it and fund it, so on and so forth. So most of our customers, I'd say all of our customers, use basic processing. But we have many other services such as banking and money movement services, risk, dispute management, and chargeback. All of these are called program management. So we have other customers who are not in the financial services that we call embedded finance customers that use our entire suite. So it ranges basically on the type of customer we have.
I'm also interested, Simon, I want to talk briefly about the kind of competitive landscape here because there is competition for you all, right? You got Fiserv, you got newer entrants like Stripe. How, Simon, do you see the kind of the competitive environment sort of shifting and how are you evolving with it?
Absolutely. I mean, the market is expanding. So where we have focused is on the fintech industry. And more recently, we're expanding into the embedded finance, which is the brands that are not in financial services that are going to offer financial services products. In that space, there's effectively only the new players, not the established players like Fiserv, TSYS, and others. So it's between ourselves and I'd say Stripe. But Stripe is more focused on the acquiring side, on the merchant side. We're on the issuing side. So we're kind of like the two companies that are approaching the market, the neo market, but from two sides of it. In terms of the competitive landscape, it's favorable to us. I mean, we do things in milliseconds that others do not do fast. So if you look at where we're going with the market and all the digital brands that a millisecond matters, that they only have a few choices, and we're one of the very few.
I also know that you guys have a very strong relationship, as I mentioned, with Block, Cash App in particular. You guys just sort of reinforced the partnership. That said, it's my understanding that that accounts for what, about half of the revenue. So I wonder if you're working, and I know that's down, are you working on further diversifying that revenue? Because that's quite reliant on one customer.
Of course, yes. I mean, first and foremost, Cash App has been a very successful product, and that's why our revenue is concentrated there. But we now have a lot of customers that are growing, and also Cash App and Square continue to grow. So while we are very excited about all the growth that we see outside Block and Cash App, we're also thrilled about the opportunity they still have in the market. So I do believe our concentration will go down because of size and scale. And I mean, we just crossed $1 billion of transactions per day. So we have many other customers that are growing fast and many use cases like accelerated wage access and new co-brands and SMB credit that will actually lift our total processing volume and reduce the dependence on Block. But I also have to say that there's so much opportunity in front of the Cash App team, in front of the Square team, and in front of the Afterpay team, which is all of Block. Mm-hmm. So it is hard to say how much we'll be able to grow. We did say that our business outside Cash is growing faster, but that doesn't mean that our dependence or our concentration is going to go down that fast because they're still growing at an amazing pace.
Gotcha. Simon Khalaf, thank you so much. Appreciate it.
Thank you for having me.
Well, let's talk about SoundHound earnings, that company that has been very closely watched by, well, users of Yahoo Finance, among others. The shares down 12% after the company's loss came out wider than estimated at 7 cents a share. The average analyst estimate was for a loss of 6 cents a share, although it was a narrowing loss year over year. As you can see, their revenue also came in below estimates at $17.1 million. 17.75 was what analysts had anticipated, although that is an increase of 80% year over year in that revenue figure. SoundHound is one of these companies, and by the way, NVIDIA also had disclosed an investment in it, is one of these companies that has been caught up in the AI enthusiasm that we've seen in this market. We just talked to Keyvan Mohajer, the CEO, recently here with us in the studio, Josh, and talked about the voice recognition advances that the company is working on based on generative AI.
Yeah, and of course, expectations for this one were just through the roof. I mean, heading into this report, that stock was up about 240% just this year, right? And a lot of that, of course, a lot of that recent move we can chalk up to what you talked about, NVIDIA, right? Disclosing that investment in the company, and of course, I think a lot of investors saw it as sort of a vote of confidence in the company, and for good reason. CEO saying here, our pace and agility amid this AI revolution, he is noting, has put us ahead of the field when it comes to delivering real commercial value. They do have competition here, and we asked the CEO about that. He just, basically said he thinks they do it better. But at least initially here, some disappointment in the after hours.
Yeah, and one more thing to mention, Bill Smead of Smead Capital Management, when he came on, talked a little bit about this. This is now a $1.8 billion company that just reported a little over $17 million in quarterly revenue. So there is a disconnect from the traditional sort of financial modeling on Wall Street.
Yes, he had strong feelings about that one, as I recall. Yeah. Moving on, President Biden and former President Trump both visiting the border this afternoon, highlighting one of the key issues for Americans in the 2024 presidential race. Our own Rick Newman is here to take a closer look at that and other economic issues voters are eyeing, Rick.
Right, so dueling visits to the border for these two candidates. I think the most important takeaway here, President Trump, he's made immigration and border crossings one of his key issues since he announced his first presidential run in 2015. Biden, not so much. This is not something he talked about in 2020 as a campaign issue. And he has discovered kind of late that immigration is a giant problem, and this is really resonating with voters. We're seeing lots of surveys saying voters are increasingly worried about immigration. Look at everything that's been happening. We've had record flows of migrants across the border. Migrants are showing up in cities across the country, including Democratic ones such as New York, Chicago, San Francisco, Los Angeles, and even the mayors in those cities are saying we need some help here. So Biden is late to this. I think the question is, this immigration bill that could have made a difference is not going to get through Congress, apparently. So Donald Trump had a role in that. He was telling Republicans in the Senate and the House, don't vote for this, so it's not even going to get a vote. So Biden has to figure out what he can do without congressional legislation. Immigration is a complete mess. It's a thorny problem. Everybody knowledgeable about this says you need legislation to fix this. The president cannot fix it on his own, but Biden's probably going to try. So by the time of the State of the Union speech next, I think it's next Thursday, I think a lot of people are expecting Biden is going to come out with something new about immigration.
Yeah. And then presumably if he tries something legislatively, we'll try to position the Republicans as being against it if they don't support his version.
That's right. So he's got to play this bank shot, which is, Trump is the one always thumping his, Trump did a really good job branding himself as the guy with the border wall, right?
Well, the wall didn't get built, did it?
Parts of it did. Some of it went up and that all stopped, and I think some of it has even come down. Trump knows how to brand himself. And look, Trump was actually passionate about this issue, right or wrong. He really did care about stopping the flow of migrants. This is just not something that Biden has spent much energy or much political capital on. So, he didn't. When it's not your main issue, you don't have as much sway on Capitol Hill to get something done. When you say, oh, by the way, now that this has become a problem, let's get this done. It's just never been a Democratic, the Democratic issue on this when Trump was president was basically stop the cruelty with children in cages and everything at the border. So Democrats are in a bind on this, and it is Biden's worst issue in the polls. Voters give him the worst marks on immigration. And, it's pretty hard to change the story with just 8 months left until the election.
Oh, and these are live pictures, by the way, of the president at the border. As you said, sort of dueling appearances by
And Trump is there, I think, right at the same time, someplace else.
Exactly.
Thank God they're not at the same spot.
Yes, that would be intriguing. Maybe an impromptu debate.
Maybe we should have an immigration debate at the border.
Governor Abbott there as well, you just saw too.
Yep.
All right, thanks, Rick.
Thanks,
Appreciate
guys.
it. On the other side of the break, cruise stocks soared in 2023 on record demand. Can the hype continue, and will you be paying more to go on a cruise? We'll talk about it next.
2023 was a banner year for cruise lines, with the likes of Royal Caribbean and Carnival enjoying roaring post-pandemic demand and record share price moves. Some new ships leave the dock this year, but will 2024 earnings stay afloat? As ever, much will depend on the consumer. We've been keen to set sail, but will we continue to do so if demand drives prices even higher? Or will loyalty to the oceans give way to reality? Yahoo Finance's Travel Guide 2024 Industry Insights guides you through the high seas of cruise ships.
Yes, travel demand for cruise vacations has risen spectacularly post-COVID, and with it, ticket prices. Norwegian Cruise Line CEO Harry Sommer called demand as robust as we have ever seen it on this week's earnings call after issuing strong guidance for 2024, adding that when demand is strong, we take advantage of it. Joining us now as part of Yahoo Finance's Travel Guide 2024 Industry Insights, we have James Hardiman, City Leisure and Travel Analyst. James, it is always good to see you. So you're pointing out, James, maybe our cruises actually could even get a bit pricier here in 2024. How come, James, and how much pricier could we see?
For sure. I mean, I think the pricing momentum, the trajectory of what we're seeing is exceedingly positive. As you mentioned, Norwegian had a really good fourth quarter, and the guidance for the first quarter, now there's some easy comparisons in there, but for pricing that's up mid-teens year over year. That's a trajectory that we won't be able to sustain. But I think what's important to understand is if you think about sort of that early pandemic and early post-pandemic period where we saw inflation across the economy, the cruise industry was largely sitting that out, right? They were on the sidelines for a good amount of that time. And so for a cruise space that's historically been, what they would argue is an unfair discount to land-based vacations, they then sat that out, and so they found themselves at an even wider gap relative to land-based. What we've seen over the last year and a half is a little bit of catch-up, getting back to maybe 2019 levels, but they look at it and see significant pricing opportunity moving forward.
At the same time, James, hey, it's Julie here. It's good to see you. At the same time, the cruise industry's message has been, we are a better value than a land-based vacation, right? All in. And so how much room do they still have to raise prices and still sort of tout that value opportunity for travelers?
Sure. Yeah. So historically, we've talked about this, maybe call it 20 to 30% discount to comparable land-based. Coming out of the pandemic, that number was probably closer to 35 to 50, depending on sort of what you're looking at. And we've seen that gap close a little bit, but I think that leaves still, on a like-for-like basis, a meaningful opportunity. And that doesn't factor in what I would argue is some pretty good innovation in the cruise industry. We've seen a number of these companies make big investments in land-based attractions, right? Private islands, resorts, water parks. And that, I think those investments have allowed them to cater to a multi-generational vacation. And I think that is only going to drive pricing higher from here.
And James, I'm curious, you look at the stocks of these names and they have enjoyed just these massive runs, James. I mean, investors clearly cheering them, they're moving in. Broadly, as you look across the market, the industry, James, any signs of softness that you would point out?
No, I mean, I think, geographically, the Caribbean is clearly the strongest region in the world right now. Europe is strong, not as strong. As a global cruise company, you do have to deal with a whole lot of stuff, including the fallout from the unrest in the Middle East and the Red Sea restrictions that have now been placed. And so sort of there's some voyages here and there that have had to be moved around the world. And certainly there's going to be a pricing impact there. But I would argue, I mean, certainly you showed the more recent price movement, but if you were to take that back to 2019, these stocks have at best held serve, right, or at best flat with 2019 relative to a market that's up dramatically. And so depending on the time frame you look at, there's some pretty meaningful underperformance here.
Do you also think that when you look across the industry that they all have some degree of pricing power right now?
I do. And it varies depending on, which new hardware you're bringing to the market, what your relative exposure is. And so, there's certainly names that we like more than others. Having said that, again, relative to, hotels, which may have stalled out here a little bit from a pricing perspective, yeah, I think the industry is strong.
James, good to see you. Thanks so much for your insight as always.
Great seeing you guys.
Thanks. Breaking news now, shares of New York Community Bank Corp are sliding after hours. The regional bank saying it is delaying a filing after it identified material weakness in the company's internal controls tied to an internal loan review. The shares down 14%. It's also announcing a change at the top. Alessandro Sandro Danello named CEO. He had been named as executive chair of the company after NYCB bought his bank, Flagstar Bank, the bank that he was leading in December. Remember, the company, of course, recently unexpectedly cut its dividend and reported larger loan loss provisions late last month. That initially sparked concerns and sparked a sell-off in the bank that was reminiscent to some degree of what happened with SVB last year.
Yeah, and people look at NYCB, Julie, and they think, okay, regional, small, not important. It's actually this is a big bank. I mean, it's an important bank. And to your point, so when it wobbled like that, I think some people did get nervous about whether this was kind of emblematic of something bigger, broader, whether this was a kind of canary in the coal mine. Consensus seemed to be that this was really kind of actually NYCB's issues were its own. It was kind of idiosyncratic, but it speaks to this broader issue. Even remember Janet Yellen weighed in. I mean, she didn't weigh in specifically on NYCB, right, but kind of talked about how, listen, these CRE issues are a concern. They're aware of it, though she, of course, quickly added that, regulators are on it and they're managing the problem.
Well, and remember NYCB had taken over the sort of remains of Signature Bank, I believe it was, or am I getting my past banks right? I think that was the one. First Horizon went to
I think
JP
you're correct.
Morgan and the puzzle pieces.
There's a lot moving around.
In any case, so now the company not giving much detail as to why it is doing this delay. It just said there was ineffective oversight, risk assessment, and monitoring activities that were revealed by this internal loan review. The assessment of the internal controls, it says in a statement, in a filing, not yet complete, but the company expects to disclose in its 2023 Form 10-K that its internal control over financial reporting were not effective as of December 31st, and it expects to describe its remediation of that in that Form 10-K, which again has not yet been filed and is now being delayed. So we'll keep an eye out for any kind of updates on all of this.
For sure.
All right, coming up, in the era of online spending and social media, shopping channels like QVC and HSN are making moves to keep up with the likes of TikTok. We're going to speak with the CEO of Curate Retail, the parent company, next. Curate Retail, the parent company of QVC and HSN shopping channels, reporting earnings on Wednesday, beating on the top and bottom lines. The company is saying it's in a transitional year and expects momentum for the rest of 2024. But in a changing entertainment landscape paired with warnings about more value-focused consumers, how does this affect business? Joining me now, Curate Retail CEO David Rawlinson, along with our own Brooke DePalma. David, thank you so much for being here. Appreciate it.
Thank you. It's a pleasure to be here.
So I want you to, for our viewers, to sort of talk about the transition that you talked about on the call as well, and sort of explain where you are in that cycle and what you expect for 2024.
Well, we're really excited about 2024. I think we are at a really special moment in retail. I think two people in retail are winning. Big box stores that we don't think is a very human experience, concrete floors, self-checkout, and algorithms, e-commerce sites that are just trying to juice you for the next big purchase and get you to trade up. What QVC and HSN and Frontgate and our other big world-class brands have always been about is connecting humans to other humans about products. We think that's the biggest opportunity in retail, is to make retail human again. And we think as we're starting to do that, we're starting to see success again in this business. And so we're really excited. We think that was behind a lot of our bottom line results in the third and fourth quarter. We grew EBITDA, our measure of profitability, for the first time in the third quarter, and over 2 years, we did it again in the fourth quarter. We grew new customers for the first time in about 3 years. We did it in the third quarter. We did it in the fourth quarter. We're just feeling real momentum in this business model right now.
Hi, David. It seems as though all of retail is really trying to tap into Gen Z. Of course, we saw the launch of TikTok Shop at the end of 2023. Who is your key audience here, and how exactly are you reaching them?
Well, we are doing a lot of things for Gen Z. We actually just launched an app called Soon that's targeted at younger customers. But I have to tell you, I also really love our core customer. So our core customer is a woman in her 30s, 40s, 50s, often the pillar of her community. We often talk about the fact that America is graying, the Western world is graying, but everybody wants to get younger, although we're growing faster amounts of older customers than we are younger customers. And so we actually think we have a beautiful opportunity, especially for mature women at a stage in life where they have extraordinary amounts of discretionary time and extraordinary amounts of discretionary income and wealth. And we think that connecting them to the celebrities they love, to hosts they love, to products that they can't find anywhere else, it is again, the biggest opportunity in retail.
Well, David, I certainly applaud the sentiment there as a woman who covers up the grays. But
you don't need to cover them.
But I am curious for your next generation audience and shopper. How do you do it all? How do you appeal to more mature women with that disposable income while at the same time cultivating the next audience?
It's about graduation and a life stage. It's about when do you have enough discretionary time and enough discretionary wealth to be a really good customer for us and where we can really meet your needs. And so we think about that a lot. What I would say is the fast and growing part of our business is our streaming business. It is streaming. It is the future. Streaming was up for us about 50% last year. We think streaming will be up for us about 50% this year. It's about 5% of our total minutes watched. People usually don't know. We had over 60 billion minutes watched last year as a company. There's just nothing else like that in terms of the level of engagement we have around our product. And so we're now taking that to streaming. Streaming is already multiple millions, billions of minutes viewed on a regular basis. This year, we think we'll more than double those minutes viewed, and we think we'll grow our revenue more than 50%. And so we think we're really well positioned. We're well positioned with this older customer who's at the right time and really wants to be spoken to as an individual. And we also think we're on all the modern platforms. We're playing with new content formats, and we're seeing really strong response in terms of the growth rates there.
David, thank you so much for your time today. I appreciate it. David Rawlinson and our own Brooke DePalma. Thank you.
Excellent. It was a real pleasure.
Coming up, what to watch tomorrow. We'll break down the stories you need to know to start your day.
Starting today, Ford EV owners will be able to access Tesla's supercharger network with the use of an adapter. Yahoo Finance's Praz Subramanian checked it out firsthand and joins us now for more. Praz.
Yeah, so a year ago, shocking news when this was announced, when Elon Musk went on Twitter Spaces with Jim Farley and they talked about this deal. And now here we are with today's the first day you can actually use an adapter. So I went to a location in New Jersey here with a Tesla supercharged location, and they provided a F-150 Lightning here for me to test out the process. So the actual adapter itself, and I have some video of that. It's actually made and is engineered, designed, and made by Tesla for use with this vehicle. And basically, what happens is you plug it into the Tesla charger, and now you have the ability to plug into the F-150 or the Ford EV, and it immediately starts charging. There's no app. There's no I got to set up my thing. I got to type this in. I got to find the charger. No, just like for Tesla, it works seamlessly for Ford, and that's really a nice thing because once you have your account set up in the Ford Pass, it's all good. It seemed relatively easy to use. Nice heft there with that adapter. And look, it's going to make it's an advantage for Ford being the first automaker to use this, to be able to access this network. I think it's a competitive advantage that a lot of people are going to want to actually consider when they don't want to buy a Tesla, but they want to use that charging network.
To go back to something we were discussing with our Akiko Fujita yesterday, what about the time it will take to charge a Ford, and is it different from the time it'll take to charge a Tesla at the same station?
Same, depending on the car's ability to basically intake a high voltage charge, and the Lightning can do that. It's just as fast as any other car, based on their voltage of the system. So it should be fine.
Okay, good to know. Thanks, Prost.
Thank you,
Appreciate
Prost.
it. Love the footage of Prost doing that. All right, let's take a look at what's trending after hours. Shares of Fisker, speaking of autos, they're falling. The company reporting preliminary fourth quarter and full year results, also saying a deal may be on the table with another automaker in order to keep the company afloat. Revenue coming in at $200 million. That's below consensus of $272 million. And Fisker also announcing a 15% cut to headcount. CEO Henrik Fisker saying that 2023 was a challenging year, including delays with suppliers. He'll be joining us on this show tomorrow. And check out shares of Zscaler. That company reporting earnings after the close as well. Second quarter results beating estimates on the top and bottom line. The guidance for the full year also coming in above analyst expectations. Unclear why the stock is down 7%. It's up about 9% this year, so it's not like it's been screaming higher into earnings. So interesting here. We'll keep on digging into the reasons behind the drop.
Time now for what to watch Friday, March 1st. Starting off with the Fed, we'll have the latest round of Fed commentary throughout the day tomorrow with 6 different officials scheduled to speak. The Fed's key inflation measure, PCE, coming out today, rising 0.4% in January as expected. Cleveland Fed President Loretta Mester telling Yahoo Finance today that 3 rate cuts this year, quote, feels about right.
And taking a look at on the earnings front, Next Gen Energy, Plug Power, Fubo TV, they're reporting earnings tomorrow. Plug Power announcing fourth quarter results before the bell. That stock's had a tough start to the year. It's down about 20%, but it did close higher today.
And moving over to housing, we'll be getting monthly construction spending data from the Census Bureau tomorrow morning. New report giving us some more insight on new housing and infrastructure projects. Housing market continuing to be tough with mortgage rates going up again today near 7%.
All right, that does it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a good evening.